Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, October 6, 2023. The S&P 500 is currently sitting at 4322. I'm David Zarling. I'm here with a fire pit aficionado, Ian McMillan. It is October. It is autumn. We've got football almost every single day. We've got backdoor fires, not like fire in the house, but like we've got our fire pits going. Market responding today after an economic narrative report. Where would you like to start?
Yeah, big response today from the market in what had been the previous 4 days. Pretty lackluster, pretty abysmal. It was not a great week. We can go back to Monday. Wednesday was okay. Yesterday, seeing some buying, but all 3 days, Wednesday, Thursday, and then again today, I would say quite a bit of, dare I say, accumulation into what's a pretty big area. We didn't quite get down to 4180, but if you look at this 4200, 4250, you got the 200-day. I know a lot of technicians.
So you're talking about the 200-day moving average of the S&P 500.
Moving average, right? So we talk about that as your pretty good 30,000-foot view of the long-term trend. Of
yep.
quote-unquote stocks. You had a year-to-date anchored VWAP.
So anchored VWAP being the volume-weighted average price, and you're saying since January 1st?
Yeah.
So that's in the same spot?
So not going to say we're out of the woods yet. Certainly not small caps are not out of the woods.
And at the same time, couldn't we throw them in that confluence of important areas? So you talked about a 200-day moving average for the S&P 500, the volume-weighted average price of the S&P 500 since January 1st, the 4180 level, which we didn't get to completely, but it's an important horizontal level related to that, the horizontal level of small caps, right? This is an important spot. To me, if you're looking back and using a big picture perspective, this 165 to 169 level needs to be held by demand, by buyers for the bullish case to continue. I'm not saying that small caps have to outperform. In fact, on a relative basis, they're not. No. But this would be a scenario. And to paint the picture, this 165 to 170 area has a relationship to February of 2020, which we all know is the beginning of the COVID crash. This is a really important horizontal level. Same with 2018. The summer of 2018, where small caps led into the summer and then corrected into Christmas. Really
skeptical of all of it.
Yeah, really important level for small caps to hold.
I mean, how many times you're going to come back to 17? All I'm saying is, yes, of course, there's a probability that this continues higher. But how many times in a healthy market do you have to come back and touch 1700?
Well, to drive that picture home, so August of 2018, we're flat.
Yeah.
Using small caps. So August of 2018 through now, we're talking 5+ years, 0% return for 2,000 stocks.
2,000 of them. And if you pull them all in a bowl and mix them together, they haven't done anything.
Right. And this is a really important level. If we built up all this energy going back to April of 22, when we first broke down into this range, and the range that I'm talking about is if you could envision two different barricades or two different fences, and on one end is 195 to 200 on IWM, the other side is 165 to 170. We're on the lower end of that range. If that were to break, that would be a pretty good indication that things are not well. If this holds, that could be a positive sign for this market, especially if we throw in holding a rising 200-day on the S&P 500, rising volume-weighted average price on the S&P 500, and a horizontal level holding above it. Because back in March, we wrote our clients and said, really, there's a couple stage process here. We have to stay above a 200-day moving average, and we have to have a sustained trade above 4180. And if we can have those two different things, we can be invested. The hard part being you had a 2-month correction, August and September, which doesn't feel very good.
Yeah, and Russell, small caps, average stock. It's just, I'm not trying to be picky. It's like you made the playoffs with like 79 wins because the rest of the division was atrocious. I don't feel amazing about the progress we have made in, okay, I know the low was October 13th of last year. We're going to call it a year because we're a week away. We're 51 weeks. For all intents and purposes, I think we can call it a year. And I'm just so unimpressed with what has occurred over the last year.
And doesn't some of that have to do with the makeup of small caps as a whole? And when you talk about being unimpressed, I thought maybe you were referring to the Brewers going 92-70 in a 162 game season and then being done out of the playoffs in 20 hours. 28 hours.
All those series were 2-0 sweeps. It was kind of a lackluster.
I'm telling you, that first game, Brewers Arizona, where Brewers had 11 hits, 4 walks, and only scored 3 runs.
And you got to get more off 11 hits in the playoffs.
Evan Longoria pretty much got to be the MVP of that series.
Is he on the Diamondbacks now?
He is. He was starting third baseman for that opening game, and he legit stole a probably bases clearing double that would have put the Brewers up 6-0.
It's an old Gamecock on the Diamondbacks that I'm really glad has kind of broken through in the majors.
Who's that?
First baseman Christian Walker.
Oh, yeah. Oh, speaking of him, so the second game, Christian Walker's at the plate. He's the cleanup hitter. Second and third base, right? So first base is open. We've got 2 outs. Your cleanup hitter is up, and it's a 3-2 count. So what do we do as a pitcher? We groove it. No, that's not what we should do. We should nibble around the edges, and if he makes contact, it's going to be poor contact. But we have an empty base for the cleanup hitter to stand on so I can face the next guy. But we grooved it. Walker hit it out of the park, and that was pretty much game 2. So not that I'm bitter, Ian.
You definitely sound like you're taking it well. I would be too. We got to do the Philly, and
What's going to happen in the McMillan household?
Yeah, this will be back to back. Well, and did they knock us out last year?
No, because I thought the Braves won the series.
No, that was 2001.
Oh my gosh.
Phillies made the World Series last year, but maybe they did not go through.
Oh, you mean 2021? It was 2 years ago.
2 years ago, the Braves won the World Series.
Maybe they did. Maybe Philly knocked them out last year, and I've just got a short memory. That sounds about right because I believe the Phillies won it last year, right? Are we about to ask our editors?
No, they lost.
They were in it and lost.
They were in it and lost. Braves did get knocked out by the Phillies.
And then Phillies went to the World Series.
Phillies went to the World Series and lost to Houston.
Oh, Houston. Everybody's favorite, Houston.
Because the Dodgers also got knocked out.
That's right. Well, all I'll say is the Braves lineup is legit.
They are.
That doesn't mean any other person's lineup is legit, but I think they're hard to beat this year. And I really thought the Brewers would be advancing, but they're not. And so now we just focus on price,
stocks,
college football, and a little bit of NFL.
That is true.
And going back to your point of confluence, meaning we've got this really, in some ways, I don't know if, and maybe this is the way a defensive lineman feels when they get through the offensive line with ease.
Like, is it screen pass?
Is it a screen pass? This is a reverse. What's happening here? Because the response of Confluence at this area on S&P 500 is so logical.
Too easy.
It's so logical.
Yes, it's so logical. Unless we all just became technicians in the last month, which I don't think happened. But yes, it's so. Now there's a lot. There's a lot there, right? So you've got a lot of different people that are watching one individual thing, and they all kind of happen to coincidentally be coming together at the same spot. So yeah, logical spot for a bounce, how long it lasts, how big it is, how long it lasts. Now, again, we got to think of the big picture is we are in a new uptrend. We do have an On the S&P and the Nasdaq, we do have upward sloping 200-day moving averages.
Yep. And we pulled back into that. So think about in summertime how it was, are we going to get a pullback? If we do get a pullback, don't we want to take advantage of this? And what would that look like? Well, if you were to drop a textbook pullback, this is what it would look like. An ABC correction into a 200-day moving average, a horizontal level, volume weighted average price.
And I would add that going into this, well, specifically on the NASDAQ and S&P, is, we pointed this out a lot, where the necklines were the Q4 2021 necklines. Both S&P and NASDAQ had momentum divergences going into those areas. They sold off, rolled over and sold off, which is what we've seen since basically August 1st, August 2nd, right into a 200-day and all the things we mentioned before, anchored VWAP. You could call it a 38.2% retracement.
Ooh.
Depending on where you want to draw your lines.
Yeah, if you're talking about the close from October, yeah, you're right. That's interesting.
If you want to use your closes.
There's some internal metrics here when we look at volume distribution, and I'll say it's different than what is maybe on a chartered market technician's test. But some of the metrics that Dan Gorkuber has brought to us, it's also a logical level. It's a point of control. It's an area of value that we're seeing demand. But in the end, all these things are great. Now they have to hold. Like, it's all good and great that the response that we're getting today, but now you have to have follow through and you have to have stickiness, and just meaning let's stay above 4180. Let's stay above 4200. Let's stay above the 200-day moving average. And that will confirm the thesis that we're moving higher. And that's just math.
I will say, so we use internally, I don't want to go into a lot of detail, but we look at some things internally that look at futures. And one of those aspects is volume. And I will say this morning, I don't know where this goes, but I will say, and you can even see this on a chart a lot. I mean, probably the most buying since March 15th.
No, that's a good point. March 15th was an important spot and got accumulated and moved higher. I think about October 13th of last year being an important bottom. At that point, you had a gap down in the morning. It was a Thursday. You had a gap down in the morning on CPI.
And that was, as I say, that was a newsy thing, right? Because a candle like that's usually, it's like today, like a newsy thing.
Right. And I guess that's where I'm going with it, is we had the consumer price index, a measurement of inflation, completely negative number according to the media.
Oh yeah, something ridiculous.
It was like 8%
Yeah, like 8.9.
Yeah, it was
9, something silly.
And we gapped down only to reverse higher the whole day and create a bullish engulfing, and the market moves higher from there. I'm not saying it's identical. We won't know that it's identical until later, but it has the same essence to it in the fact that today was non-farm payrolls, and we gap down in the futures, and all that's happened since the open is getting bought. And so we're not that long from close. And here we've got this bullish engulfing on our hands. Do we get to be surprised that this was an intermediate low in a counter trend move to move higher? Again, it feels a little too easy, but sometimes it's like that. We'll see.
Or it's a 2-day thing. It was too easy, and it's a 2-day thing. And in a couple of weeks, we're talking about being below 4180.
I mean, I don't want us to be below 4180 because that probably means small caps are breaking below 165. That probably means micro caps are breaking even lower.
Yeah,
which just means further carnage.
When we talked about earlier, I mean, right? So you talked about the makeup of Russell, and regional banks doesn't look so hot.
They really haven't recovered, regional banks. I'm using KRE. We're not that far off of the March lows when we had Silicon Valley Bank, and there were several. And actually, they've kind of slipped my mind, but I know Silicon Valley Bank was one of them, SVB.
They're a bunch of West Coast, Pac West.
Yep. With one New York bank that was also in that mix. So you continue to see weakness in regional banks. If you were to see a thesis develop where the Russell 2000 is below 165 using IWM. Microcaps using IWC continue to have sustained trade below 99, which is where they're at now. And you see KRE, which is a regional bank ETF, or BKX, which is a NASDAQ bank index. If we're breaking to new lows, we probably have some loud narrative going on regarding something going on with banking. And that's probably pulling a lot of other things lower. We don't know. Like, there's no way to know that. And we haven't even talked bonds yet.
Not a good week for bonds.
No,
not a good week whatsoever. Nothing has changed with that trend. I mean, they're getting, they're off the lows today. They're still down 85 basis points. But yeah, so what was that? Late September, we broke those October 2022 lows. Not the same. They bottomed about a week after stocks did. But back below that, I mean, just abysmal. You take out dividends, and I know that's still right. Oh, Ian, people buy bonds for the dividends. Okay.
You're allowed to, I think you're allowed to look at the chart both ways.
But so let's say we take away the cash flows, which I'm reserving the right to do as a technician. I just want to see whether people wanted to own it or buy it, regardless of whether they were getting paid anything. You take away the cash flows. You can put an asterisk next to this if you want. We are back to summer of 2007 price levels. So roughly 16 plus years of capital appreciation given back since March of 2020. So about 3.5 years. You gave back 16 years. We add the dividends. We add the cash flows. You're back to April 2014.
Yep. So we've had this huge discounting going on within the credit universe. You have the 20-year government bond yield north of 5%, which is a new development over the last 3 weeks. You have mortgage rates north of 7%. And let's be honest, the sentiment is pretty negative.
I think even north of 8.
Yeah, the last I saw was 7.875, but you could be spot on. There could be 8+% mortgages. I'm not here to argue that. But I would say consumer sentiment on bonds and mortgages is super negative. We have record treasury shorting going on. So short positions against the US government bond. This is a recipe, because all shorting is potential future buyers if they get squeezed. So think about just a stack of logs with some gasoline on it. All it's waiting for is a match. And is there an environment where we're seeing...
Put those in the solo stove.
Yeah, that's what you got to do. Get that solo stove going. Beautiful.
It doesn't take a lot to unwind that.
No.
Because covering, that's how you get short squeezes. It's a rush for the door.
Right.
I'm just trying to lock in or limit losses, depending on how quick you are.
Exactly. And so if we see a short squeeze in treasuries, which would mean interest rates as a whole would be impacted, right? You see interest rates pull back in. That would be significant as well, because some of this is a rate of change issue, right? When interest rates change rapidly, they tend to have impacts on the periphery, whether it's equities or otherwise. But when you see the rate of change stabilize, that's just making sure that the rules stay the same across the board. That can be very positive for equities. So you could see a scenario where this confluence of the lower range on small caps, a reclamation of micro caps of its lower boundary. You see the S&P 500 hold these important areas, the 200-day moving average, 4180, the volume weighted average price, and you get a short squeeze in treasuries. That thesis it's not crazy. Like, it's sitting there, like, ready to happen.
Maybe 2024 is the year for the average stock.
Yeah.
Maybe the average stock's just going to get a late start in the bull market cycle. I mean, it's a probability. I think historically speaking, right, you would have liked to have seen it start at some point in the last 12 months. But
well, and if it's going to happen, wouldn't it make sense to happen in the strongest 6 months, right? Even a presidential cycle now through March typically is pretty strong. Now that's TBD. We're talking about 1 day response at an important area. Is this the start of a new leg in the most positive 6 months out of a 12-month period, that being October, November, December, January, February, March. That's TBD. We'll see.
We'll see.
The beauty of using technical analysis and price is that we can have levels that identify when that thesis is wrong. And that's the beauty of using technical analysis, is it tells us when we're wrong. I wish I had that secret weapon in discussions with my wife. And I don't mean that in any mean type of way. It's just, it's very cut and dry. If we're not above 4180, if we're not above a 200-day moving average on the S&P, if we're not above 165 on small caps,
That's why I use it with my children. If your room is not clean, if your toys are not picked up, and I can chart it out.
Yeah, no, that's a good point. If
I can chart my son's behavior in uptrend or downtrend.
If small caps could please pick up their room, that would be really appreciated.
Please pick up the Legos.
Can you? Because I really don't want to time out. Because this range that goes back to March of 2022, think about that. This is October of 23, right? We're talking about 18 months of sideways range in IWM. That's a lot of energy if we resolve to the downside.
In a wide range. Like, I know we did this in...
It's like the mid-70s.
2019, and I know we did that. Like, this is a wide range. This is a 20% range.
We haven't seen a range this wide since the mid-1970s.
The media, going by the media definition, you got bull and bear markets over the last 18 months, multiple of them.
That's a great point, actually. Can you walk through that?
This 20% move, well, we'll use that. Then we've got 3 bull markets and 4 bear markets in the last 18 months.
Yeah, that's a great point. Let's walk through that again. You're saying that the media likes to use plus 20 and minus 20 as bull market and bear market markers.
Yeah.
And you're simply saying that IWM, since April or March of 2022, we've had 1, 2, almost 3, borderline 4 bear markets, and 1, 2, 3 borderline bull markets. So massive range, highly unusual. And I don't mean that in like, we just haven't seen it in a long time. Markets do unusual things all the time. It's kind of like weather. Weather does extreme things all the time, which is a little bit of oxymoron, but it's true.
It is.
And there's
always some, oh my gosh, this hasn't happened in 25 years.
Right. The uncommon commonly happens in markets.
There's always some once in a decade event every couple months in some asset class, some fat tail.
Right. And here we have IWM in a 20+% range for well over a year. That's a lot of stored energy and direction.
It is. It's a lot of pent up energy, and I hope it wasn't distribution.
Right. And Ian, when he says that, Ian's talking about distribution, meaning are these large institutions who are managing billions, borderline trillions, actually distributing into this, meaning providing supply, and the actual resolution out of this range is lower? That might sound like fear mongering, but we have to be open to that thesis. The other side of that thesis is we hold 165, we move higher, we broaden out. The next 6 months, we just rip. But the beauty is we have technical analysis. We have the study of supply and demand to show us we're at this pivotal point. And now it's a matter of, does price prove one direction versus the other? Will IWM hold the 165, 170 level? Will microcaps using IWC reclaim the $100 level? Will the S&P 500 hold the 4180, the 200-day, the August of 2022 highs? Will the NASDAQ 100 continue to stay above its August of 2023 low? These are all important dynamics that we want to be monitoring. And could we see a scenario where we see a short squeeze in treasuries? We could, but until price reverses.
Yeah, right. And when we talk about moves, okay, so let's talk about moves higher in treasuries. Are we officially in the camp that any move higher in treasuries is a counter trend move?
It gotta be, right?
Like if we zoom out, like, and I'm talking like we have all seen this chart over the last 2-3 years.
I don't know that my mom has though.
Your yields, put your yields up and go all the way back to the 80s and draw your trend line, right? So we've all seen this. And we've all seen we broke above this trend last April 2022. And you've got to be in the camp. We're 3 years into a new 30 to 40 year cycle, and any dip in rates, which would be a spike in treasury prices and bond prices,
would be temporary.
And I say temporary. This can be weeks and months.
Yeah, right. We could be 6 months of falling rates, but it doesn't fix
It can be years. Right? We saw rates go up for years over the last 40 years, but they still tanked.
Right.
You had 2016 to 2018 rates went up. You had periods where, 98 to 08, 98 to 2011, rates were essentially flat. Mm-hmm. Now, they went a few different places in both directions, but flat. And so could you see that? Absolutely. We averaged 5% on 30-year T-bonds for over a decade. So do we see that now? Could you see us stall out here for a decade on the way back up?
Oh, absolutely.
Maybe.
Yeah. And that rate stabilization would actually be a positive for equities.
It would be.
And at the same time, it doesn't mean the higher rate environment is over. I think too often people think lower rates, better equities, and that may be changing. There was an environment in the 50s and 60s, right? Because the 1980, 1982, if we want to call that a top in rates, a bottom in bonds, there was still positive equity developments. Yes, there was the lost decade in the 70s for equities. But prior to that, the 50s and 60s were a roaring bull market. And you know who benefited? The big multinational company.
Was that the Nifty 50 thing?
Yeah, that was the Nifty 50 thing.
Before my time. So that's all I know it is. It's the Nifty 50 thing.
Right. And we get it confused with there's a Nifty index for India. What we're talking about is there were 50 companies, 50 stocks that did really, really well. They were multinational companies, meaning their revenues didn't just come from the US, they came internationally. And they benefited from an interest rate environment during that period of time, and they moved higher. And what does that sound very familiar with?
So this was kind of a point I was going to make. Do higher rates they don't kill equities, but the quality companies probably bubble to the top of accumulation.
Right. Because they can play an interest rate arbitrage game. They can issue credit. They can take on debt in different nations. Doesn't have to be the US, and they can play that international game of debt cost. And so these multinational big companies, and I know right now we're calling them the Magnificent Seven, and that sounds all fun and great. And some people get nervous about how big they're getting as a weighting. And I get it, like that happens. But until that dynamic starts to shift and change, and you get a correction in things like Apple, you get a correction in things like Microsoft or Google or NVIDIA or Amazon, and we're just not seeing that yet. Now, we've pulled back. I'm not saying we didn't pull back in something like Apple since the beginning of August, but here's another logical place for Apple to get accumulated, which is into a 200-day moving average, into a horizontal level around 172, 180. You have a divergent RSI.
Right into that. It's not a bad weekly chart on Apple.
No.
You're back above your August 2022 highs.
Yeah. Like, do you continue to see the big get bigger? And this is appropriate for the postseason for baseball, right?
Divergence.
There's always the unsung hero that does well in the postseason. Then that's absolutely true. But typically those who win the postseason, it's when you're that's actually pretty good. Drew Holiday. You're going NBA on me, and we
and then you guys let him
go. Dude, it's heartbreaking. I love Drew Holiday.
The day after he said he wanted to retire in Milwaukee, and you guys were like, okay, off to Portland. And then off to Boston.
I know Drew listens to this podcast, and
he does.
I have mixed emotions. Like, it's not like Damian Lillard's bad basketball player. Don't get me wrong. He's phenomenal.
True.
He's phenomenal. But it's not like Drew was important to one of the championships that the Bucks won.
Yeah.
And so you don't get to throw that away. And now he's got going to the East. Now he's with the Celtics. Are you kidding me? Are you
going to have to probably play him every year in the conference finals?
NBA just wrote itself a novel because the Eastern finals, highly likelihood we're seeing Celtics Bucks, and it's Drew versus Damian Lillard. But I digress. The point being, if Drew Holiday or Damian Lillard or Apple in the postseason, Apple's in a position, Microsoft's in a position, Amazon, Nvidia, Google, Tesla. These are the mega cap names that if they're doing well in a interest rate environment that is rising, that shouldn't surprise us because we have market history. We have the 50s and 60s to show us these big multinational companies, right? Because Apple's not just US, Microsoft's not just US, Amazon's not just US, Nvidia's not just US. These are big conglomerates and mega cap stocks. We don't get to be surprised if they carry the market higher in an interest rate environment that's rising.
These companies can probably handle all the Forex.
Yeah, exactly.
Back and forth. They're not living and dying quarter to quarter on what the yen or the euro or the dollar does in regards to their top and bottom line. If we're going to have at least, okay, let's say this, whatever, like it doesn't go. Let's say we have at a minimum another decade of rising rates, which I think is a pretty conservative estimate.
Mm-hmm.
Where are you going to put, and again, we're not, I'm not trying to, I'm not giving a speech at a CFA conference here, but logically,
you should.
Where's that going to go? Companies that can, they're not stressed over, the euro shot up. Are we now going to lose essentially 10% on overseas sales?
Yeah, because what's a U.S. company that's 100% U.S. revenue based supposed to do about interest rates? It's not like they can go to Japan and issue debt, right? They can't. There's no currency arbitrage there. They can't.
Yeah, your small cap industrial companies not.
And so we have this situation where you do have the Magnificent Seven. You've got these mega cap names that can overcome some of the interest rate environment, some of the currency environment. And speaking of currency environment, one thing that's interesting to me that I know we shared internally is just the characteristic of where we are with the Japanese yen. And people are like right now listening going, what? We just went from this great conversation about mega caps and interest rate, and now you're going to talk about the Japanese yen. And the reason why I'm going there is when we look at a chart of the Japanese yen versus the US dollar, and you look at when most stocks, I'm not saying all stocks, most stocks started correcting. It was January of 2021. And that's when you saw the yen weaken dramatically against the US dollar. And guess when it bottomed, Ian? That relationship, October of 2022, which we now know as being for many stocks, an important bottom. And we're back at that same place for the yen versus the dollar as we were in October of 2022. So if this holds, would this be marking another important or significant bottom in equities? That's to be determined. It's a thesis. I'm not saying that's what it is.
Are you putting that in the it's too easy category?
I am.
I don't mean that, and I do not mean that in some egotistical way. I'll add it into the bucket of things that seem to be lining up.
Yes, 100%. Like when you look at all the things we talked about previously, 200-day moving average, 4180, volume weighted average price, that's all S&P 500. You look at the 165 to 170 areas on IWM small caps. You look at IWC, if it can reclaim its bottom horizontal level, if you look at treasuries or even something like real estate, XLRE, if that can reclaim a prior low, and this is happening where this is happening with the yen, there are a lot of pieces of evidence that show, okay.
You have a lot of big double bottoms out there. Things that went back to their October lows, yes.
Yes.
October 2022 lows.
Yep. Would be a logical level. It works inversely too. It's not like we're saying here, no matter, without a doubt, stocks are moving higher. This goes back last week's podcast title of a pivot. This level that we're at in so many things is going to provide so many clues. We're either rising out of here for the next 6 months and it's going to be rip roaring, or we're at a point where these things fail, and that is tremendous information.
That would stink.
It would.
And that's how I feel okay, so yeah, let's use XLRE as an example. So big double bottom potential, right?
Yep.
But then when I zoom out, I'm like, yeah, man, that's great. I'm so glad you found that piece of driftwood, but you are still kind of lost at sea.
Yep.
So, we got work to get back to shore.
Right. We got to stay above $34 to keep breathing. on XLRE. And if we can do that, that's another piece of evidence that we've reached an important pivotal low and move higher in stocks. But if that fails, that's information too. We're not here, Ian and I are not here to tell our listeners which way this market is going to go. Nobody knows that but the good Lord Almighty. But we can use price to identify when we're at really important levels where we're going to get a resolution one way or the other. And XLRE is a perfect example of if it cannot hold this 33, 34 level, it's a bit of a problem.
It's going to be real telling if we give today's move back next week.
Yes. This week is pivotal in the sense of on many different charts where we're creating what's called a hammer candle. A hammer candle is we open at a certain price on Monday. We retreat lower only to close either above Monday's price or around it, which leaves this what's called a wick or a tail behind it. That's step one. Unless you have follow through though. So next week is kind of an important week. Can we see continued accumulation and a follow through in what happened this week? That would be important. Is that a fair statement to make?
Yeah. I mean, it's gotta, right? I mean, you can't just get one first down. We've got to move towards the goal line. And we got some charts that are on their opponent's 20, and we still got some charts that are inside their own 20.
That's actually a fantastic point to make in the sense of if you're looking at something like a bullish percent index, which is measuring how many stocks are on a bullish percent point and figure buy signal. And I'm talking shop now. I'm not expecting our clients to understand this, but if you're a technician, we are down in the 30% range, which is if we are we gaining possession on the 20 off of a fumble or off of a punt return, and we're about to go on offense? We won't know that until we flip to X's on the bullish percent. And that would be hugely valuable. The same thing with the percentage of stocks that are above their 50-day moving average. We've pulled significantly back in the last 2 months. This is typically an area right in here when you look at the metrics where you like to see that hold. So we're at an important time. October is an important time. We said it last week. It's an amplifier directionally. Either we're breaking these levels this month and next, and there's a problem in the market, which we have a solution to, right? We can move to T-bills and cash, or it's the seasonal norm, and this is where we start to see stocks and even bonds move higher. That's TBD, but we need to see follow through next week, which is what I think you were saying, Ian.
I was.
So we've covered a lot. We didn't touch base on crypto. We haven't even touched really that much on crypto or commodities. Anything you want to touch base on before we wrap this up?
No, I mean, other than it's a start, we've still got a little bit of time left in the day today, but should we close here? I don't know. Maybe if this comes to fruition and we're back here in mid-November or December and stocks have moved higher, we're at year-to-date highs at least. I don't know. Maybe technical analysis won't be so goofy after all.
Right.
There's just a lot lining up, positively speaking. So we'll see if it takes effect.
Let's be honest. We like markets that move higher. That makes it easier to manage money. That makes it easier for accounts to grow. At the same time, if we're below those important levels, if orange is below blue, if a 5-day moving average is below a 200-day moving average, we're protecting client accounts. That's a standard fact. And we have to see in the upcoming weeks what this delivers. But as Ian said, this is a logical level where we would see accumulation return, and we have the best 6 months heading into next year. Time will tell. I have no idea if this is the future. But with that, Ian, we bumped up against the remainder of our time. I will ask our listeners to give us high rankings. I will highlight that the sponsor of this podcast, the supporter of this podcast, the Adaptive Select ETF listed on the NYSE under ticker ADPV, does help investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV by visiting adpvetf.com or calling 1-833-880-5200. Again, if you listen to this podcast, you like the information, we do ask you to share it. Give us a high ranking. We're sitting here on a Friday afternoon providing this information to you. Hopefully it's appreciative and it's something useful to you. Ian, thanks for being on here with me. I really appreciate it.
Have a great weekend, everyone.